VGT's higher returns look tempting, but CGGR's better Sharpe ratio means you're getting more bang for your risk buck. Now let's shift gears and look at VGT, crushed it with 141% returns over 3 years. That's the kind of dominance that makes every other fund jealous. But here's where it gets interesting. CGGR's 122% return trails by 19 points. But let's be real. More than doubling your money is still killer growth here. In plain English, VGT won the race on total returns, but CGGR wasn't far behind. Think race cars. One had more horsepower, but both engines roared down the track with serious performance. Over 5 years, VGT crushed it with 127% returns, proving this wasn't just a lucky short-term win, but sustained outperformance. Here's where the story takes a turn. CGGR's 91% return sounds solid until you realize the gap kept widening, falling further behind as years passed. Let's break this down further. VGT's 19% gain over 12 months shows it's keeping pace well, consistent performance that's holding strong through recent market moves. Now for the real question. CGGR's 17% return is solid, but it's still trailing behind VGT in this head-to-head matchup over the year. In plain English, VGT's consistently outpaced the competition at every checkpoint, like a marathon runner who's faster at every mile marker. Same race, same conditions, but VGT simply maintained a stronger pace throughout. Here's where things get revealing. CGGR's higher Sharpe ratio reveals the real winner. It delivered more bang for your buck while taking on less risk overall. Now let's put this in perspective. CGGR's 1.3 Sharpe ratio means you're getting solid returns without riding a wild roller coaster. Efficiency matters when volatility hits. But wait, there's more to this story. VGT's 1.2 Sharpe ratio shows decent risk-adjusted returns, but higher volatility ate into efficiency despite those stronger raw gains. Risk-adjusted returns work like mechanical leverage. CGGR achieved superior efficiency by applying less risk force to generate strong returns, while VGT required greater volatility input for comparable output. Let's take a closer look. CGGR's 0.7 Sharpe ratio over 5 years shows consistent risk-adjusted returns. You're getting smoother, more efficient gains across all time frames here. Now here's where it gets tricky. VGT's 0.6 Sharpe ratio reveals decent returns, but you're shouldering more volatility for each unit of gain compared to competitors. But that's not the whole picture. CGGR's 1.8 Sortino ratio means you're getting solid returns without the brutal downside hits that'll keep you up at night. Let's see how this plays out. VGT's Sortino of 1.7 shows it's decent at limiting downside risk, but there's definitely room for improvement here. In plain English, when markets crash, CGGR cushions the fall better than SPY, like storm brewing, where both flights hit turbulence, but one's got better shock absorbers for passengers riding out rough patches. Now let's talk worst-case scenarios. Maximum drawdown shows you exactly how much pain you'll need to stomach when markets crash hard. But hold on a second. A 35% crash tests whether you'll panic sell or hold steady. That's the real cost of chasing tech's upside. Let's unpack this a bit. Quick pause here. Who's your pick for the winner? Drop CGGR or VGT below. Here's the key takeaway. CGGR's worst drop was 29%. That's 6 percentage points less punishment than its competitor when markets crashed hard. In plain English, think of maximum drawdown like a roller coaster drop. VGT plunged steeper on the scariest descent, while CGGR dipped hard too, just not as vertically down the track. But there's a catch. Over a year underwater before breaking even, that's 402 days of watching your money do absolutely nothing. Let's get into the weeds here. CGGR took 413 days to bounce back, slower than VGT, despite losing less, showing recovery speed isn't just about drop size. In plain English, both funds took the same amount of time to recover from their lows. Like watching the sunrise, it's the same journey from darkness to daybreak. Patience pays either way. But here's where it gets interesting. VGT's volatility is a double-edged sword. It supercharges gains in bull markets, but amplifies the pain when things turn south. Let's zoom in on this. VGT's swinging 22% over 3 months. That's serious turbulence that'll test your stomach for both explosive gains and brutal drops. CGGR's 18% volatility means you're getting 4 percentage points less drama daily, a calmer ride while still capturing serious growth potential. In plain English, VGT's volatility is like cranking an amplifier knob to maximum. You'll get louder highs when tech's booming, but those lows hit harder too. More intensity across the board. Let's break this down further. Beta's your fund's sensitivity meter. Higher means it'll swing harder when markets move, amplifying both the thrills and the spills. Now for the real question. VGT's 1.4 beta means it swings 40% harder than the market. Bigger wins when times are good, steeper falls when they're not. Let's dig into the details. CGGR's beta sits at 1.2 over 5 years, still volatile, but noticeably calmer than VGT's wilder 1.5 swings. In plain English, think of it like a car engine. High beta funds rev up fast when markets accelerate, while low beta funds cruise smoother with steadier power delivery through the turns. Now let's put this in perspective. Fees might seem tiny, but they're quietly eroding your returns year after year, and those losses compound dramatically over time. But wait, there's more to this story. VGT delivered higher returns at 141%, but CGGR's the efficiency winner here. Lower volatility, lower beta, and a better Sharpe ratio at 1.3. Sometimes winning means taking less risk for solid gains. Here's the thing though, VGT's expense ratio is just 0.09%. You're keeping almost every dollar of your tech gains here. Let's take a closer look. CGGR charges 0.39% annually. That gap compounds over decades, quietly eroding your returns before you even notice it's happening. In plain English, VGT's low expense ratio finds you pennies under the couch cushions, while CGGR's higher fees lose nickels. Seems tiny now, but these small differences compound into thousands over decades of investing. But that's not the whole picture. Technology concentration explains everything here. It's not stock picking skill. It's simply how much tech exposure each fund carries. Let's see how this plays out. VGT is all in on tech at 98% allocation, pure concentration with zero safety net. That's maximum exposure, maximum risk. Here's what really matters. CGGR keeps just 33% in tech, way more balanced than most growth funds that go all in on one sector. In plain English, VGT's basically betting the farm on tech. Nearly everything's in one sector. CGGR plays it safer, spreading investments across multiple sectors, like a diversified basket strategy. But hold on a second. CGGR is adding 12% healthcare here, a defensive play that'll cushion the blow when those tech stocks get choppy and volatile. Let's unpack this a bit. VGT's got zero healthcare exposure. It's pure tech aggression with no defensive cushion when markets get rough. In plain English, here's the thing about healthcare exposure. CGGR uses it as a shock absorber when tech takes a hit, while VGT's all in on one sector. It's portfolio seesaw economics. Now let's flip the script. CGGR spreads the risk here. 15% in consumer discretionary means you're not putting all your eggs in the tech basket. But there's a catch. VGT's purely tech. Zero consumer discretionary exposure means you're betting entirely on one sector with no diversification whatsoever here. In plain English, CGGR is like ordering a pizza with every topping, diversified across consumer spending. VGT, and that's a pepperoni-only pie. Pure tech, no variety, different risk appetites, different slices. Now we're checking how many stocks each fund owns. More holdings usually means you're spreading your risk around better. But here's where it gets interesting. VGT holds 325 individual stocks, giving you broad tech exposure while staying focused on the sector's biggest winners. Let's zoom in on this. CGGR keeps it focused with 105 individual stocks. Fewer bets, but they're spreading across multiple sectors for balanced diversification. In plain English, VGT's concentrated approach means fewer holdings but bigger bets on each one. CGGR spreads risk across more companies, juggling multiple patterns instead of putting all their eggs in one basket. Here's the real twist. VGT holds more stocks but concentrates in one sector, while CGGR's smaller portfolio spreads across multiple industries. Let's break this down further. VGT's tech-heavy strategy crushed it across every time period. Turns out betting big on technology absolutely paid off here. Now for the real question. CGGR's diversification really shines here. You're getting better risk-adjusted returns with smaller drawdowns, giving you that crucial downside protection when markets turn. In plain English, here's the choice. VGT's the rocket blast-off. Explosive gains when tech soars, but you're riding volatile fuel. CGGR's your marathon runner, steady, reliable growth without the heart-stopping drops. Here's where things get revealing. VGT's 0.09% fee versus CGGR 0.39% means you're keeping more of your gains over decades. That's meaningful money compounding in your favor. Now let's put this in perspective. Your timeline matters here. Younger investors can ride VGT's wild swings, while those seeking stability should lean toward CGGR as broader diversification. In plain English, VGT's the power hitter swinging for home runs. Big rewards but higher strikeout risk. CGGR's your contact hitter, consistently getting on base with steady, reliable returns. Different batting strategies for different investors. Here's the thing though, your investment timeline decides the winner here. VGT's growth shines long-term, while CGGR's stability protects you short-term. Let's take a closer look. Two very different approaches here. VGT for aggressive long-term growth seekers, CGGR for those wanting balanced protection over moderate timeframes. In plain English, VGT is built for sprinters chasing quick wins. CGGR, that's your marathon runner. Steady, reliable, built for the long haul. Different races need different strategies, and this one's all about endurance. But that's not the whole picture. You're responsible for your decisions. Consult professionals before investing. Past performance doesn't guarantee future results. Let's see how this plays out. That's it for this ETF battle. Hit subscribe if you want more weekly breakdowns comparing funds head-to-head with real data.